Had a little bit of a dip for no reason that I knew about. I mean, I did not see why we had a dip in the first place. But already we've recovered. Well, it's amazing how fast we can go down. We were at 39.28 in the morning. We dropped down to 38.80, you know, which is what, 40 points. That's I mean, it's about 1%, right? 40 points is 1% on the S&P. So see, math. Math is amazing. But that's what I was talking about in the Morning Post. You know, when you have a rally with no substance behind it, then you don't have any real price discovery. Price is whatever it is the next time somebody bids. There's no fixed value that you've assigned to something. Oh, look at look at GameStop. No, it's a microcosm of the whole thing. I mean, here's GameStop chugging along at 20 bucks, you know, or whatever it was, but you know, 15 bucks or whatever that number is, doesn't matter. I mean, it's hard to tell because of the scale now. But let's say, you know, 15, 20 bucks for GameStop, on and on for quite a long time. I mean, this is going back to, well, can't tell that, but anyway, so for a very long time, GameStop's been a fairly dead stock, nothing going on there, obviously, because it's a terrible year. They stuck in the malls, they got no people. Most people are buying games and crap online. I mean, they were on their way out without being pushed by COVID. It certainly hasn't gotten better. Then all of a sudden, the rumor board picks it up. They start pushing GameStop. They find they get a critical mass of people who start getting interested. They start plowing into a stock that has no volume. It has no business. But the thing is, somebody here was shorting it. Somebody here at 15 was shorting it to zero, basically. They got screwed. They held on during this, and then they got reamed, and they had to capitulate. And so you did have a very big short squeeze on the thing. And they went all the way up to 500 bucks. We started shorting them down here. In fact, we didn't short them enough, frankly. We could have been more aggressive. But you know, when it hit 350 to 500 range, I was like, okay, this is the time when you can short it. Because there's just no freaking way it's ever going to cover it. Now, we've said that about other stocks too. We've said that about Tesla. We've said that about Chipotle. And so far, we're wrong. But this just happened very quickly, whereas they're taking time for the same effect. Because there is a reality to price. And the point I was making this morning about Bitcoin. If we were talking about Bitcoin, I was saying, look, there's 11 million Bitcoins in the world. That's how many Bitcoins there are total. And these are not unknowable things. You just go to Google and you say, how, I mean, before you buy something, take the time to check it out. How many Bitcoins are there? Oh, sorry, 21 million. So my math, actually my math was wrong. 21 million Bitcoins. That makes it worse. I had 11 stuck in my head. So that means 21 million Bitcoins are worth $1 trillion. All the rest of the math is correct. Because the actual transaction was half of what I thought. So there's half as much going into Bitcoin as I thought. So these numbers are wrong by half. So in other words, there's $1 trillion worth of Bitcoins. There's 21,050,000 Bitcoins out there. And did anyone put $1 trillion into Bitcoin? How do you know they're worth $1 trillion? You know, when we're very fooled by our concept of numbers and how things work, because when you are paid, for something, or when you buy something, you're making a direct exchange. You've determined a value for the thing that you're buying. When you know the value fluctuates, You buy a car. You're generally in the $40,000 range for buying a car is what you consider a regular car price. You know, and that's you. There's somebody else might consider $100,000 a regular car price, but you say 40. I say 600 a month. My attitude is I for some reason like I get fixated on 600 a month. So if I can lease something for $600 a month, I don't care what it costs. I just care how much it leases for. So it depends on your attitude. So when I see 800 a month or 1,000 a month, I say no, thank you. When I see 400 a month, I'm like, wow, that's pretty good, but it seems a little cheap. What's wrong with it? But I always kind of figure 600 a month. And I know I got my first car was 300 a month, so it's gone up in the 40 years I've been driving. But yeah, I mean, not that car actually. I'm sorry, 30 years, because my first nice car that I ever got was 300 a month. It was an RX-7 convertible. I like that car. And it was like $297 a month. I was like, ooh, that's a lot of money. Anyway, so you go in with a price in mind that you're going to pay for something and you buy, but there's a very big variation between cars, even the same model, even the same thing. My Porsche now is a platinum Porsche edition, and it costs probably more because it's platinum, but they just happen to be the one that was sitting on the lot that I liked. So you pay more or less for things for various reasons or whatever, but the bottom line is that there's a certain range that over time trues up, and frankly, that range is something that you can put on a chart, right? So if we say Bitcoin, that's what we use. Hit this thing, the Bitcoin to US dollar. So Bitcoin doesn't really have a range, unless you consider this a range, but your range can be 7,500 to 50,000 cannot be your range. As opposed to the range of, let's say, gold. Well, I'm sorry, that's Barrett gold. I mean gold. So you look at gold, and gold also fluctuates, but not that extreme. It's 13 to 19. It's up 50%. That's a stretch. But the real range is more like the trailing average. What's the 200-day average for something? And obviously it's trending up, and something can trend up and things can get more expensive, but they stay in a range generally. They're going to stay somewhere around a rational amount, be above or below what most people are willing to pay. That's what moving averages are good for. With that's Barrick. When you're into something like Bitcoin, when you see something like completely flying away from a normal range, where it was around the range, it went too far down, it went up, it went too far up, it went down, too far down, it goes back up. But now it's like it's peeling away from the 200-day moving average. That means that the price hasn't really been discovered yet. When you're that far away, and that's what standard deviations are, right? So when you are multiple standard deviations away from the average price that people are willing to pay, this is what was actually paid by the average person, and this is the current price. $16,000, $17,000 here, $46,000, $45,000 here. So in other words, the average price that people paid for this many Bitcoins volume-wise over the last 200 days, 30, 60, 90, 120, 180, 150, 180, 200. So since here, the average person has paid 75 to 15, so about 100% more. So it's gone up about 100% for the average transaction over the last 200 days. That's the reality. We would have to have another 100 days in which it flies up higher for this thing to get to that level, for this average to get to that level. And plus, think about the volume. Then you look at the volume and say, well, you know what's happened? What else happened in the last 100 days? There's been lower volume. Look at these volume lines. Look at these volume lines. There's been less volume here on the way up than there was during the previous discovery session. The previous discovery session on higher volume is what brought you down around the 7,500 line. So there's little evidence to support the value proposition that the next person who buys a Bitcoin is going to want to spend $4,500, $45,000 or $50,000 on. The less transactions you have to support a price, the less supported the price is. It's a real simple, basic fact of math, and that's what TA is kind of based on. Although it's a bastardized, dopey way to look at it, the reality is the chart is just indicating what this is. That's why charts don't tell you what's going to happen. Charts just tell you what did happen, but that's fine. Understanding that is critical. When you understand why something happened or what did happen, you can kind of get a feeling of what's going on. So what did happen? There was a push in volume. There's some excitement. People went into Bitcoin and bid it up tremendously from $20,000 to $50,000. It bid it up 150% in this very short amount of time. That was on the volume burst, okay, just like GameStop. Since then, the volume has trailed off considerably back to this kind of level. But as long as no great amount of people wish to sell their Bitcoin, that's fine. If everybody's happy with their Bitcoin, is waiting for $50,000, that's fine. But should doubts be sown in the Bitcoin community, should the sentiment turn the other way, where is the volume for these people to sell into? How are these people going to sell this many Bitcoins back in the market once they lose interest? How are they going to take their profit? Anybody who bought here is profitable up to here. But this transaction volume, the average transaction volume was, what do we say, 400,000 a day. So let's say it's 500,000. 1, 2, 3, 4, 5, 6, 7, 8, 9. So let's say it's 10 days. So that's 5 million Bitcoins. Let's say 50% more than that. Let's say 7.5 million Bitcoins were transacted total. But they weren't all bought. They were bought, sold, bought, sold, bought, sold. So there's no net influx of money going on. They're just being bought and sold for various prices. There's no money coming in to support the price. The problem is when it goes out, when people want to sell and get cash for their Bitcoins, they've got to find people who are willing to trade $50,000 for a Bitcoin. And are there people like that? Yes, there are. There's 400,000 people each day who want to do that. But there's not 4 million people a day. So God forbid a lot of people want to sell their Bitcoins at the same time. You've got a serious, serious problem. And that is when you get into a real price discovery. Brendan saying, what are your thoughts on oil? Should we roll our SCO trade from 9 to 8? All right, honestly, I have no idea what SCO trade that is. So you have to remind me. But SCO is the ultra short oil, and yes, I don't know what the trade exactly is, but here you go, it fell off the table here. I imagine we had done some kind of spread, expecting oil to go lower over time, and instead it went the other way. It's gone much higher. So, yes, you do want to roll and keep on top of something. I don't remember what the spread was. If you let me know, I'll tell you exactly how I would adjust it. Oil be crazy though, right? Here's the EIA report. Let's see if we've got the update. Ending February 5th, seems like a long time ago, but that was right. Yeah, okay, that's the correct report. So $152,000 barrels more input, 83% of group capacity. Gasoline production increased. Distillate fuel production increased. So that's interesting. So gasoline is up very slightly, So gasoline's up 1 million barrels for the week. Distillate fuel production is up, was that what? 130. It's called 2 million. So there's 3 million more barrels being produced. What does 3 million barrels more being produced mean? It means that 3 million more barrels of oil were used to produce 3 million barrels of distillate and motor fuel. So that's the question. If we produced more here, that means we sucked it out of the oil. So therefore, more oil input to the refineries. I'm sorry, there wasn't more input to the refineries. It was used from the refinery inventory. Therefore, we turned the oil into the distillate products. The net effect is that we went from 2.9 here to, 629 to 516. Whoa, to 516. Wow, because look at all other oils, right? Big draw. Actually, it's a much stronger draw than we thought. See, that's why you got to wait for this report, because that draw thought it was totally the other way, but now we get into all other oils. Turns out to have a big draw last week, and I imagine that's because it's heating oil and stuff. And we had really cold weather. So yeah, 7 million barrel draw in heating oil. So overall, we're down 11 million barrels. That's a good sized draw. So that does kind of justify the pop in oil. Where is that CL? Here's the CL. But still, overall, the demand picture isn't keeping up with this enthusiasm. We're not, look, $60 oil is not realistic. It wasn't realistic before the virus. Why is it realistic now? So here's 2018. We were above 60 into the summer, but then failed completely. 2019, barely spent a day above 60. Totally collapsed in 2020. And now we're all the way back to 60 as if happy days are here again. Completely unrealistic on so many levels. There's no pressing war. There's no shortages. OPEC's on cutback. There's an incredible amount of spare capacity. We've got extra shale capacity. The environmental crap is going to kick in next year. There is just no reason why it should be this expensive. So gasoline too is also popping up, but gasoline is trickier to short. It's easier to short oil. Natural gas is coming back to trend. But you know, natural gas is one of the things we're switching to from oil. How's the dollar doing? Oh, look at that. That's sad. These guys are all happy, right? And down a little bit today, but no big deal. UK, Europe's is up there. Germany's up there. Europe's lagging. See, they should be at all-time highs. Why are they moving up? And should they be at all-time highs? No, of course not. Nobody should be. But everybody else is, so they may as well join the party, right? There's no reason not to. May as well. So we will see what happens. Our portfolio is at an all-time high, as usual. Just like the market, the long-term portfolio keeps chugging along. Where are we? $223%. Wow. So that's up like another $60,000 since last week, right? We were 155 or something like that. So that's crazy. But you know, when you look at what's in it, it doesn't seem so crazy. Oh yeah, we don't have Chipotle and stuff. We don't have those kind of things here. We got, you know, Plains Pipeline not doing well because they cut the pipeline. Got Berkshire Hathaway. China Mobile is a dead issue at the moment. We got Cisco, Foot Locker, Gilead twice, Gold. Goldman Sachs never loses. IMAX coming back. Intel, trade of the year. Macy's, marijuana ETF, of course, going gangbusters. Wow, look at that, 108,000. Because we were aggressively long, right? Because we have 108,000 there because we had much more longs than we had shorts. 3M, who make all the masks, and now they're saying you should wear 2 masks at a time instead of 1. It's like that. That's really fun to go out in. Philip Morris, Pfizer, of course, another high up stock. Tanger Factory Outlet, we love them. Simon Property, the mall guys. SunPower, huge. AT&T, still slow, but still, you know, doing nicely anyway. And Walgreens, distributing the drugs. always bet on the drug dealers. It's the end of my lunch. So that is the LTP. That's ridiculous. But the market keeps going up, the LTP keeps going up. What are you gonna do? Short-term portfolio down 50%. But the gains in the long-term portfolio are far outpacing the losses in the short-term portfolio, so that's fine. That's exactly what we want. And we have adequate protection. Dividend portfolio, 61%. We're only trying to make 30% a year in the dividend portfolio, so that's crazy. Earnings portfolio, 186. These are just ridiculous gains. It's just completely silly. And why? We have Aurora Cannabis. That one expired. So Aurora Cannabis, after the split and the thing and the reverse split and whatever they did, we only have 7 shares, but they're up nicely now. iRobot, still doing good in the consumer space. Gilead again, Hanes, Intel, of course, we're always going to have that. Macy's, we love Macy's. There's a hedge in this one too, the SQQ hedge, and Walgreens again. So honestly, it's not that different than the long-term portfolio. It's kind of redundant. Future is now portfolio 100%. Yeah. Just pick. Look, there's no skill to this. You just throw darts on the wall. The thing is, with our option strategies, we get a huge amount of leverage, and that gives you an incredibly large return. But that's what's going on. If a market's going to go up and up and up, we're going to make a fortune, and that's what we're doing in all of our portfolios. And then there's a money talk portfolio, and this is one we don't even touch, and it's up 60%. Oh, I'm sorry, that's in 2 years, so that's from 2019. So the money talk portfolio is up 60% in 2 years, but we don't even, we only trade it once a quarter. But what's in it? Same crap, the same things I always love. IBM, Intel, Macy's, Pfizer, Tanger Factory Outlet, and SunPower. The same things I always talk about. And I wish it was more exciting to invest in a tricky market, but it's not, because frankly, you pick safe stocks that are going to go up. If everything's going up like crazy and you want to make 100%, why pick the crazy stocks? Why pick the crazy stocks when Pfizer can give you 100%? Why pick a crazy stock when Intel can give you 100%? If everything's going up, then good stocks are part of everything, and you can invest in good stocks. You don't need to invest in bad stocks. And that's what you see in these portfolios is good stocks. And you don't see, there's nothing faddish in these things. Even the future is now portfolio is not very well. We of course cut everything that was questionable. That's the other thing. All these portfolios are just the things that are sitting around that we absolutely love. But Jets is the airline ETF. Sienna is doing well also. SunPower. I mean, that's what we're left with here. So, I mean, it's only 3 stocks now, but those 3 stocks since December of 2019 in a year and a couple of months are up 100%. It's not those 3. We had a whole bunch of other stuff in between, but we cashed them all out because they did really well. They took off already. We had a Plug in there at one time because Plug we thought was undervalued. Now it's not undervalued, so we don't play it anymore. You got to learn to move on. That's another thing. You got to say, okay, you know what? I had a good run. Let's find something else. You know, when Plug went up here, we were like, okay, bye. Let's sell that now. Because you don't take a stock that you bought at 30, have it at 60, and then say, oh, I'm going to wait for 120 to cash out. Take the money and run. When you're up 100%, take the money and run. Doubling your money is good. You cannot sit there waiting for your 5 times returns. And that's the problem when you see these things like GameStop and you only remember the good times, right? You only remember the people tell you, oh, you made so much money on GameStop. These guys didn't make money on GameStop. This guy didn't make money on GameStop. That guy didn't make money on GameStop. That guy didn't make money. All these people who jumped on this, in fact, all these people, this guy buying here, unless he was a genius and sold right there a day later, he didn't make money on GameStop either. Even this smart guy 1 week ago who said, ooh, it's at 200, it's going to go higher. He bought it, goes to 5. If he doesn't take his money at 4 and get the hell out, he almost certainly took a loss. Because then it comes back, and then he said, well, I bought it for 200, so it's certainly going to go below 200. Then it gaps down to 150. Then the next day it's down to 100. Then the next day it's down to 50. And that's what you call price discovery. Now you find out what people are really willing to pay, and it sure as shit wasn't $500. And if the thing you're chasing has not engaged in price discovery, where is Bitcoin gone? So in other words, if the thing you're thinking of buying has not engaged in price discovery, which is i.e. a pullback of good proportion, then you have no idea what it's really worth. You're just completely throwing darts in the wind. And why do you need to do that? Why should I mess around with Bitcoin? Because I think it's going to do what? Go to 100,000, 200,000? I can buy Pfizer for $35. Here's Pfizer's price discovery. Over 2 years. It's a $35 stock. I can buy it for $35. Now that doesn't sound very sexy. Do I think it's going to go to 70? Do not think it's going to go to 70. What I think though is that if I go to trade Pfizer, I go to January 23rd, January 2023, and I sell the $33 put for $4.75. Okay, so let's say I sell 5 of those for $4.75. Calculator. So 475 times 5. That did not work. 475 times 5. So $23.75. So I'm going to get a $23.75 credit for selling the 33 puts. So step number 1, I have to have in my mind a price I'm willing to pay for Pfizer. If I'm willing to pay 33 and someone's going to pay me $4.75 because I'm going to promise to buy 500 shares of Pfizer for $33, then that $23.75 he's going to pay me is free money. I can now do what I want with it because it has no effect on my life. Okay? If I want a Toyota Camry that's $40,000, and I go to the car dealer and I say, I tell you what, if you pay me $3,000, I promise to buy the Camry for $37,000, 10% off. $36,000 would be 10% off. So I promise to buy the Camry for 10% off if you pay me 10% of the price. And you're like, well, they would never do that. That's crazy. Why would they do that? I don't know. The car dealer would not do that, but you know what? Options traders will. And there's reasons they do it, because they want to protect themselves. They want to make sure somebody's going to buy their stock. But that's, you know why? Because they have not engaged in price discovery, because they are not fundamental traders. They don't have a value in mind for their stock. Your car dealer has a value in mind for his Camry. He has engaged in price discovery, and he understands how much people are willing to pay for a Camry. He knows there is no circumstance under which he is going to be stuck. No realistic circumstance. I mean, 9/11 or whatever. But there's no circumstance realistically that he's going to be stuck with that Camry and can't sell it to somebody for $37,000. Doesn't have to be you. Somebody's going to buy the freaking Camry for $37,000. So why on earth would he pay you $3,000 to be sure that you'll buy it for $37,000? That makes no sense. That just locks in $37,000 then, but he doesn't have a reason to do that. That's where we are. We are the dealers. If you are a fundamentalist and you understand what you're selling, and you understand the value with a big V and a big A and a big everything else, you understand the value of what you're buying, then you are in the same position as that car dealership, and you understand the car dealer, don't you? You get that. That makes sense to you. You're like, well, why would he give me money to buy the car for a lower price when he knows he can sell it? No shit. That is the whole premise of what we're doing here. But the problem is that I see is that you guys, not everybody, but some of you, the ones who tend to ask a lot of questions, frankly, but you guys basically are like, you don't have a fixed value that you see in the stock that you're buying. And part of it is because you buy really bad stocks. You buy these stupid things that have very little history, very little discovery, that don't have a clear path, that you don't know what the price is. It has wild swings. You're paying too much. There's a lot of reasons for this. This is why, for me, this kind of market, it's really dull, because there's not a lot of stocks that are exciting to buy, but there are stocks that are good to buy, like Pfizer. Because Pfizer is still cheap. It's not sexy enough to get caught up in these things. It's too big to manipulate, so it just lays around at its normal price range in $35. So we're not going to pay 35, but you know what I'll say? If it gets to 33, which is only 5% below the current price, if it gets to 33, I don't mind buying it. So leg number one, and you can do 30 for $3. You can be a little more conservative and only collect $1,500. But you go, I know where I want Pfizer, so I know 33 is good. I'll take the extra money. To me, the risk of paying $3 more for 500 shares, which by the way is $1,500, the risk of paying $1,500 isn't worth me not collecting $800 more to sell the 33 puts. I'd rather have the $800 because I don't consider it to be a huge risk that I'm going to pay $1,500 more for the stock. That's all it is. It's a trade-off, right? How sure am I? More than 50% sure. That's how much I'm spending to be sure. I'm collecting $800 more to pay $1,500 more. So my net, how much net more would I pay? I'm paying net $700 more. That's my total risk here. I either buy 1,500 shares for 33 minus 23.75, or I buy 1,500 shares for 30 minus $1,500. So minus $1,500 is 28 and 14,000. So here it'd be 14,000, and here it would be, I can't do the math. So here it would be 33 times 500 minus what was that, 23.75 or something like that. So 14 is basically the same freaking price. So you see how that is? It's really not even different. It's not even a different price. It doesn't make enough difference to me. My net entry, should I lose, makes no difference. So I'd rather have the $800 now. Thank you very much. I don't consider that a risk. I certainly don't consider it a risk to own 500 shares of Pfizer. So therefore, I'll take that. That's free money. All right, so I'm going to take my, what we say, 475? 475 times 500 Wow. 475 times 5. Oh, for God's sakes. 475 times 5. There. So I'll take my 2375. And then what am I going to do with the 2375? I promised to buy 500 shares of Pfizer. My target for Pfizer, I don't think it's going to go much over 35. I'm not looking for it to do great, but I think 37 is fair. So if I take the 30 for 650, 660, let's say 660, so or 655 actually. So 655, I mean to do that. So 655 for the 30s minus 3, let's say 355. So let's say it's a $3 spread. The 30-37 spread is $3. How much did we collect on the calculator? We collected 2375. How much is it going to cost if we buy 10 of them, 10 spreads? It's going to be $3,000. 10 spreads times $7, if we hit it, is going to be a $7,000 payoff, and we're only spending $625 net dollars to be in it. That's how you make 10 times back on your money. Don't forget, we're at 35 now. So we're 5 times, we're $5,000 in the money to start on that trade. On a trade that you can buy for net, remember you're selling 5 puts and you're buying 10 long spreads. The 10 long spreads cost you $3,000. The 5 puts credit you $23.75, so your net is a difference, obviously, $625. So for $625, you're into a 30-37 spread, which is a $7,000 spread. So your upside is $6,000 something dollars. It's almost a 10 times return on your money. Is Bitcoin going to go up 10 times? No. Well, I hope not. If Bitcoin goes up 10 times, the world economy is over. So is Bitcoin going to go up 10 times? Let's hope not. Okay. And then all this shit also, GameStop, whatever. Is anything you're going to buy really worth chasing that much when you can do this instead? When you can be $5,000 in the money for $625 on a blue chip pharmaceutical giant stock that you know for a fact is selling vaccines all over the place that were not reflected in last year's numbers. In fact, the R&D took place last year, costing them money, and now next year they're going to be vaccinating people and collecting money. It's almost frustrating that I can't convey this to people. It really is. It's like trying to explain that Apple spent all this time and effort making this iPhone, and now this year they're going to sell the iPhone. And everybody, and people, because we had this problem back at the time too. It's like, it's a fucking phone that's a camera and a calculator, and it does a computer, and it does all this and that, and blah 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 blah. And people are like, I don't know, I don't see the value in that. Don't forget, Apple was our stock of the year 3 years in a row, because every year I was like, it's still not high enough. I just was like it was killing me how cheap Apple was every year. I was like, are you kidding me? I used to go on, you guys have been here a while. I used to go on ranting regularly, like, that's like the cheapest stock in the universe. I was like, how can people possibly think this is the value of Apple? So obvious, and this Pfizer is so obvious. It's like they're going to be vaccinating people around the world, not just America. Okay, not just America. In America alone, 200 million doses of the vaccine have been sold by Pfizer. 200 million doses. Let's say it's only $10 a dose, and it isn't. I'm sure it's a lot more, but. So 200 million doses, that's $2 billion. And we do our research. Then we go to Pfizer. We say, well, is that a big deal for Pfizer? Is that a number they care about? So we go to like Stockopedia or something like that. Can't go to Yahoo anymore. I don't know what premium Yahoo looks like, but the regular Yahoo sucks now. But this is how we build a stock premise, right? Here's Pfizer, 200 billion market cap, $184 billion enterprise value, so the critics are down on them apparently. 41 billion in revenue, which you can see over here anyway. 41 billion, 42 billion in revenue. In 2020, a $10 billion profit, usually 15, 11, 12, call it high teens. I call it a teen profit that they'll usually get. This year, $20 billion projected. Next year, $17 billion projected, but I don't think they're taking the COVID vaccine into account. So does $2 billion matter here? Of course it does. It's 10% to the bottom line. Is it only going to be a one-time thing? No, it is not going to be only a one-time thing. It's going to be going on forever. You're going to get COVID vaccine the way you get flu shots. And Pfizer is the leader in the vaccines. Okay, there's AstraZeneca, there's Moderna, there's the Russians. The Russians and Chinese are doing their own, so don't count those. But the rest of the world is very, very much counting on. In fact, I don't know if you guys know this. I actually had access to the AstraZeneca vaccine. I've been talking to people in foreign countries about purchasing it. And actually, the Netherlands might be the first country we have that's going to buy it from us. And AstraZeneca just got some good news about from the World Health Organization endorsing their vaccine. They're like the least of the three. Now that's the thing, and we don't know what the Chinese one does. We don't know what the Russian one does. But the bottom line is that the ones that everybody wants are Pfizer and Moderna right now. Those are the two top vaccines. Every year, Pfizer and Moderna are now highly in the lead with the vaccine. They will then begin a regular cycle of, obviously, it's like the flu. It's like the same thing. They have to every year research it, find out what strains are out there, COVID, and you're going to have to get vaccinated every freaking year like the flu. All of us. It's going to be a much bigger business than the flu is. Flu shots already are 200 million plus people in America get a flu shot every year. This is going to be bigger than that, more expensive than that, and for other countries as well. So why would you not believe Pfizer has a future? And I'm not saying explosive growth future. This is their job. Whether it's COVID or something else, it's their job to basically identify and treat and prevent diseases. That's what they do for a living. This is only an illustration of how they function. 20 years ago, Pfizer did not know they were going to be in the erectile dysfunction business, right? That wasn't a thing. Nobody was in the erectile dysfunction business, but then it became a thing, and they came up with a good cure, or whatever, well, not a cure, but Viagra, and they made a fortune. Okay, you don't know when you're a pharmaceutical company how you're going to make your money, but you do know you're in the business of preventing and treating and curing diseases. And therefore, when you find a disease, you try to prevent, cure, and treat it. And that's what they do. And so this is the newest one. It's going to be a huge money maker. It's a shame to think of it that way, but realistically, it's because it's so deadly. And that's how these pharmaceuticals, and that's the problem. That's the problem with Pfizer is they don't get to accentuate that, nor do even analysts like to talk about it either. An analyst doesn't like to talk about how much money Pfizer is going to make off of COVID. They don't like to say, let's invest in Pfizer because of COVID. Hedge funds don't like to do that either. Nobody likes to do that. It's ghoulish. But as a long-term basic investment, this is a great long-term corporate play. They pay a huge dividend. It's a great stock to own, so that's another reason we can be aggressive on the short puts. And all we're doing is obligating ourselves to buy 500 shares of Pfizer, which would be about $15,000 or 17,000 bucks. So we're obligating ourselves to buy 500 shares of Pfizer, but we have the potentially upside of what do we say was about $6,000 something in 2 years against our what? Against our $15,000 obligation to buy it. That's a perfectly acceptable rate of return on our full obligation. The reality is, though, that we're only going to be using a very small amount of our portfolio margin to buy this, to make this trade. Whatever the short put margin is where we're obligated. And so we're tying up very little margin, making a substantial amount of money on a very conservative bet. So do I want to do that, or do I want to chase freaking GameStop, or do I want to chase Bitcoins and things like that? You know, that's my main objection to these asset classes, to these momentum trades, to these faddish trades. It's that the opportunity cost of owning a perfectly good thing that's going to pay off just as much or better makes no sense. If there was nothing else out there, maybe. Like in 2000s, in late 1999, there was literally nothing you could trade. And we're getting close to that now. You know, the stocks that were left in the long-term portfolio, and I'm talking when it was 180% up, which was only a month ago, and now it's 220. It's up 40% in a month, basically, or less than 2 months at most. Where are we? So now we're up 220%. 224%, excuse me. So now we're up 224%. Went up more while we were talking. $1.62 million. We started with $500,000 in December of 2019. So a year and a quarter ago, basically. 5 quarters ago. And we pared it down. So as of, you know, what you have left in this portfolio were the stocks that I felt still had room to run. Otherwise, we would have sold them, right? Anything that we didn't think had room to run, we sold. These were all the ones that I thought still hadn't taken off yet. So now today we're talking about Pfizer, but Pfizer's already in here. And look at the spread, 30.37. Look at the put sale, $35 put, aggressive put sale. The same logic. And believe me, I have no memory, so I didn't even realize that. But it's the same logic, because the logic is the absolute, because it's a fact. And if you understand the fundamentals of these things, it is like math. There is a correct answer in math. And there's a correct answer in playing these stocks. And the correct answer for Pfizer is don't take a big risk, play it to inch up to 37, sell the puts aggressively because you don't mind owning it, and then just wait patiently for the payoff. And look at this one. Here's the net of this one. 40,000 minus 23 is 17, minus 10 is $7,100, and this is a $35,000 spread. 50 times $7, $35,000 spread, $7,000 in. It's effectively identical to what we just discussed. But that's how we make $30,000 in the LTP. And that's a respectable amount of money to make. And that's just in 2 years. We're going to make more than that, really, because these are only September puts. So if these puts expire worthless, we will again sell them and make more money. We'll make another $10,000, basically. We'll resell more puts. So that's how we play this game. But it's not, and again, I'm not that kind of trader. I'm just not the kind of trader that buys crazy stocks and chases things and goes faddish and whatever. I am a fundamental trader. I like to buy good stocks when they're cheap and take options on them and leverage our returns using the options. It is not that exciting. It really isn't. But it's exciting to make the money, right? It's exciting to consistently build your portfolio instead of this freaking train wreck roller coaster everybody likes to go on. So Brendan says we bought 50 of the $9 calls, I imagine, of SCO with no spread in the short-term portfolio with the March expiration. Ooh, that's not good. Okay, so let's take a look at that. And so we're back to talking about SCO. SCO went the wrong way on us. We bought, I guess this was last week's webinar. I don't remember, obviously I didn't log in the short-term portfolio yet. So we bought the $9 calls, there were 50 of them. Well, Brendan, what price? Can you answer that one so I can be on track here? We bought 50 of the $9 calls. And the reason we did that was to limit our risk because, you know, let's say we spent 60 cents on it or something like that. That would have been $3,000. So we're basically risking $3,000 to make that trade. As it stands now, we're down 50% or whatever it is on it. So, again, he's not answering. So assuming that we spent that we spent 60, 70 cents, right? We're down now half on the spread. We've lost half our money. So here's the thing though, 65, he says, okay, right. So it was 65, now it's 30, 35. So we lost basically half our money. So 5,000 times 65 was 3,000, blah, 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 whatever, $3,200. So it's about $3,200 that we spent. Now it's down to $1,500, let's say, or $1,600. So we've lost half. So the question is it a knee-jerk thing though? We have until March. March is 37 days away. And now we have to say to ourselves, okay, well, we're in these puts. We're at $8 now. SCO is a 2 times ETF. And what do we think oil is going to do? So now we go back to oil. And again, this is value, you know, this is fundamental value trading. We're not guessing and we're not making stuff up. We're looking at oil and we're saying, well, what do we think is going to happen realistically in the next, this too long a time period. So in the next 30 days, that's too short. All right, so in the next 30 days, so here's a 30-day period. This is only a 10-day period. So in the next 30 days, what do we think is going to happen? We think we're going to go back to 50. So we're going to drop 10, not more than 10, 20%. So we're going to have a 20% pullback. A 20% pullback in oil would be a 40% pop in SCO because it's a 2 times ETF. So currently, SCO is at 850. So 8.15 times 1.4, that's about the best we think we're going to do. Is 1140 is the best we're going to do. If the $9 put goes to 1140, what's it going to be? It's going to be $2.40 at least, right? So without spending any more money, we can get to $2.40. That's from 35 cents. So is it really worth it for us to spend more money now and put down another, what would it be, another 30, so another $1,500, $1,600, $1,700 to put into a roll? And I don't think it is. I frankly don't see that it's worth it now. We made a bet and we lost the bet. We lost half the bet. So do we double down? And the answer is no. And the reason it's no is because if we win this bet, if we were right and oil goes the other way, we're still going to make the money. We aren't in a position where we can't win. Even if it only goes down 10%, and it's 8.16 times 1.2. Whoop, that's divided. 8.16 times 1.2. So if it goes to 979, that's not as good. We're only going to get our money back. So if it drops 10%, we're going to get our money back. If it drops 20%, we're going to do really well. We're going to make double our money back at least. But that's a big difference for us. So it's right at the edge right now of where we would do something. So then you also have to say, so what's our opportunity cost here? Oh, there's no delta. Let's see if we can change that to delta. Delta. Shit. Bid, custom, instrument, Greeks. Delta. There you go. Aha. All right. So the delta, that's the change. So in other words, if SCO drops $1, then this contract, the 9, will drop 34 cents. All right, which would be 0 basically. But you know, that's actually, see, it's funny, it's not true. The deltas aren't exactly true, because in this case it's screwed up, isn't it? It's supposedly going to drop 34 cents, but it's not, because if it dropped $1, it would become the value of the 10s, and the 10s are 20 cents. So it's really only going to lose 10 cents of value. It's a little skewed. But the point being that the 8s that we would theoretically roll to have a delta of 58. They have a higher delta. So if we roll now, all we're kind of doing is exposing ourselves to a worse downside if it goes down. We have a slightly better upside, but not that much better. And also, we're spending $1,500 for no particular reason. So we don't have, at this point now, there's not enough incentive. Also, it was a very short-term move. It only happened in the course of a week. We haven't given it any time to correct or anything else. So it's too early. So in other words, last week here, we said it would go down, and instead of going down, it went up. Now, if next week it goes back down, we will see where we are and evaluate. But there's nothing in this EIA report that fundamentally made us change our mind. We think that it's mostly a result of the cold weather. We think this thing of all other oils, and it says number 4. Let's see what number 4 says. Oh, don't you hate that? It's got a little 4 here, but there's no corresponding 4. So what's the point? That's great. Hey, this one, here's a 2, here's a 3, here's another 3, here's a 4. It means something to somebody. Anyway, distillate fuel stocks located in the Northeast Heating Reserve are not included. Data may add, not be subject to, all right, whatever. All right. So anyway, so we think that it's a function of the colder weather to some extent. Okay. I saw yesterday there was something about not United. I think it was Air Canada laying off 1,500 employees. And Air Canada is not a big airline, and they're laying off people. The stimulus isn't coming fast enough for the airlines to save them. We don't have any kind of big holiday travel seat thing. President's Day is this weekend. Nobody really goes anywhere for President's Day. It's not a big holiday like that. After President's Day, we go to Easter. And Easter is, I don't know, when is Easter? April 4th, so it's early April. But so we got President's Day, then we have Easter. I don't think there's anything else going on in March, is there? Then you've got nothing else in April, nothing in, and then May, of course, you have your Labor Day, Memorial Day, whatever day that is in May. And that's when you get into driving season, but not so much Easter and not so much this. So there's no real summer driving season. That's why they call it summer driving season until basically the end of May. There's no big upside catalyst. So I don't think that I would really be counting on oil to keep going up. So the shorter answer to this question is it's a bit early to roll this, and I would rather most likely roll for time. So in other words, I would rather roll these when it's appropriate to these 8s or these 9s and buy more time to be right. So if I believe in the trade, rather than spending more money to be at a lower strike, I'm more likely to buy time, or a combination of both. Because let's say, for example, we took these March 9s and we say, okay, this didn't work out. We're left with, let's say, a quarter by the time we make a decision. And we have a quarter here. And what we say is we'll take that quarter and we're going to buy the 8s for, let's say, 90 cents. And we're going to sell the 10s for 35 cents. So that's 55 cents, less the quarter is 30 cents. So we'd be spending the same 30 cents to be in the $2, 8 to 10 spread in April. So what we've done is we've given up a higher upside potential, but we've moved a month back further. We still picked up the dollar in strike, and we have an upside payback of $2. And what have we spent? We spent our original 65 cents plus 30 cents for the roll is 95 cents. So as long as we can recoup 95 cents, so we have that same $9 target. As long as we get back to 9, we're going to get out of the trade even. Anything over $9 is going to be a bonus for us. And so what are we actually betting? We're betting that oil is going to go back below 57.50 basically. And as long as that happens, we're going to be in good shape. But now we have all the way until, let's say, right now we have February and March. So we have until here, and we're buying this much time to get down to here. So would that have worked out last year? Well, last year was all pretty much downhill, wasn't it? But that's, of course, the virus was coming last year. But in February, what happened? For early February, look what happened last year. Early February, up, 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 up. Then later in February, but again, this is because the virus took hold, right? And things started shutting down, but it fell off a freaking cliff. No one's saying that's going to happen for sure again. 2019, we went up until April, stayed up until May, but then had a disappointing summer. In 2018, we were, oh, look, February started off with a bang, but then collapsed. And then we went back up, of course, into the summer and then collapsed. So, we don't know for sure what's going to happen. Buying more time is probably better for us than buying the position, though, because it's an old trend, because it's going to move quickly. Oh, okay. All right, what else is going on? So we got that. We talked about the Bitcoin stuff and how we don't think that's going to hold up. I think, I know we should talk about the top trades. Yogi's got a test play on DHT. Okay, so let's take a look at yesterday. We had some top trades. We had four trade ideas yesterday. We've been on a roll actually. After having no top, I think we had no top trades in January. Nope, there's one, gold. All right, so we had December 30th, January 7th, oh, and January 22nd. Oh, that's not bad. Okay, so we had 2 in January. But then we came out of the box in February. We had Pfizer. Oh, Pfizer, what a surprise, right? So we have Pfizer. And then we had Western Union. How are they doing? Oh, they're coming back a little bit. Nice. Look at that. Wait, is that live? We thought Western Union was fairly undervalued. And again, boring, right? Boring stocks. So there's Western Union. I think they got hit on earnings or something. I don't remember why we jumped into them, but we just decided they were kind of silly. Yodi pointed it out. Oh, they have a nice dividend and everything too. So again, very conservative though, right? We did the 20-30 bull call spread. They're in the 20s. And here, okay, so let's make this one bigger. And here we were looking for like inflation hedges. Okay, that was the primary principle. The idea here was to find some trades. 8800 had asked like what's good hedges for inflation, and I had been mulling this over anyway because we didn't do our Secret Santa inflation hedges this year. Why? Because today the CPI indicates there was no inflation. They just put out the CPI report today that shows no inflation, 0% inflation. You know that's bullshit. As a consumer of Grubhub and things like that, I will tell you these prices have gone insane. Really insane. The delivery prices are crazy now. I mean, the restaurants are charging more per dish. The delivery services are tacking on more fees. So the cost of, the cost of food, if you go to a supermarket or something, is probably still cheap. But to have it take, to order it in is terrible. We keep changing one form of entertainment for another. The actual cost of HBO or a subscription service may not have changed, but now it's all broken up, and instead of having, like, I don't know, my cable bill is like $300 or something like that for all the crap we have. That's just crazy. Of course I have high-speed internet and stuff for business, but it's just a little bit nutty how much money they can charge people for basic, like, internet and entertainment. We pay way more than any other country in the world. We are suckers. Anyway, so there is inflation, and there's also, obviously, I didn't get into it here, but I think we got into it in Monday's article, right? Didn't we? We talked about inflation. At some point we talked about inflation. Bubbles. Russell. PE ratios. Was it Monday? Market's still going up. Inflation, yes. So, we talked about inflation here, and this is our money supply. Hang on. Let's open a new tab. Oh, okay. It's only the last few years. But this is our money supply. This is kooky. Oh, I'm sorry, because I should have. Let's do it. Let's try it again. Okay. So this is the $4 trillion line. This is a $7 trillion line up here. We are flying past this. This is old. We're about to have $2 trillion more dollars appear out of thin air. That's going to put us like up here. This is 100%, like up here, the 100% increase in the money supply in a year or a year and a half. If you increase the money supply 100%, if in any way, shape, or form the money supply drives inflation, you're in big trouble. And we've done this before. And here's the times that we've done it before. After World War I, went heavily in debt, printed money, did stimulus. 17%, 18%, 14, 15. World War II, 8.3, 14.4, 8.1. That's not so terrible, right? Vietnam, 6.2, 11, 9.1. You say it's not so terrible, but if you remember, if you're that old, it was whip inflation now. That was the Gerald Ford campaign button, or what? It wasn't a campaign, was it? He wasn't really campaigning. It was right after Nixon. Anyway, this was Ford's when Ford took office, whatever you call it, because he never got elected. Do you guys know that Gerald Ford was only ever elected by a district in Michigan? He was a representative. He wasn't a senator. He was a representative. He was voted in. Oh, hang on, we gotta find this. Gerald Ford election. No. It's kind of Wikipedia though. Gerald Ford Wikipedia. Okay, here you go. Gerald Ford. Is it going to show it? Come on. Usually I like people's campaigns. Assassination attempt. Him? 2 assassinations. Geez, Squeaky Fromme. I thought it was Reagan. Oh, see, I remember her. Squeaky Fromme. House Minority Leader, Warren Commission, House of Representatives. I wanted to find it. It's a crazy number. It's okay. Anyway, let's say for argument's sake, 100,000 people voted for Gerald Ford. So forget Trump, who's talking about millions and millions of people who voted for him, but he lost, right? Gerald Ford was elected to the House of Representatives in 1949. Wow. Really? Fourth member of the House of Representatives, 25 years, fifth from 49 to 473. Blah, blah, blah. Okay, so. This isn't explaining anything. Michigan's 5th congressional district. And it's not going to tell you how many votes. Oh, well. Anyway, it is like 100,000 people voted for Gerald Ford, though, and he became the president of the United States. That's the incredible thing. Like, that's all the people who ever voted for him were the people in this Michigan district. And because he became the Speaker of the House, and because he was Speaker of the House, when Agnew resigned and Nixon resigned, he was the next in line. That's crazy. and of course he never he wasn't reelected. So basically that's all the people who ever voted for him to be president. So that's very interesting. Anyway, so that was not the point at all. The point was to talk about his campaign, Whip Inflation Now. So this was 1974, and now we go back to what we were talking about, whatever that was. 1974 inflation was 11%. It had gone up from 6.2 it went up from 3 point something percent, 5% when Nixon was resigning around this time of year, and then it was hitting 10, 11% in 74, and it was considered a national crisis. You kids do not remember this because this has not happened in so many freaking years. And where's my link? I didn't have I didn't link to this chart. It was a good chart. All right, so you kids don't even know what this is like. You can't even imagine what it's like to see inflation 10%. And the next year, 10%. And it didn't really go down much. We just had this persistent sort of inflation. It probably went down to 6 or something like that. But then, yeah, I mixed that up. After Vietnam, well, this was after Vietnam, but it was also after Watergate, because Watergate was right here. So Watergate was here, and this was a crisis. Anyway, so then Carter, Reagan years and whatever. Big inflation. It's 40. I mean, look at it, it's 40 something percent, but it compounds. So it's almost like 50% in 4 years inflation. It's great if you own a house, but it's terrible if you don't own a house. If you don't own a house, you're so screwed when you have inflation like this. If you don't own a home, if your assets are not in things that appreciate with inflation, you can get really burned on these things. Because you may never own a house. The whole concept of owning a house can get away from you really fast. So that's what got us back to the inflation trade. So while there is no core inflation, while there's no inflation that they count, we are really on the precipice of having a massive inflationary event. And if we do, who knows what's going to happen, frankly. I mean, this economy can go completely wacko. Because of the debt burden the United States now carries, this can become a huge problem. But we're not worrying about that now. We're just talking about the concept of hedging against inflation. So, and again, we're value shopping. We're still value shopping. So wheat and precious metals, I'm not going to go over every play, but wheat and precious metals, a 1,614% play, just saying that it's going to get back up to 50. 50 is there, not a big stretch. And again, we're insuring against inflation with these trades. Gold itself, Barrick Gold, obviously last year's stock of the year. They're back down, so we like them. We got out because they got up here, and we said that's our goal was 30. And we said, well, if it's 30, we sell. I don't care if it's too early, we sell because it hit our goal. Value again. What are we saying now? Well, get back to 27 now. So are we even lowering we're lowering our goal further out. But if it gets to 27, we're going to make 4,100% on that one. Then DBA is the food ETF, but I didn't like that. Sorry. OIH. OIH is the drillers. So if you want to make a play on oil, play the drillers, or play VLO, which is a refiner. And both of these are obviously popping now because it's suddenly coming in fashion. So if oil does continue to do well, we have OIH, we have VLO, and then I can hedge it by playing shorting my oils, which obviously is not going well at the moment, but not really the point. Active trader. No, so it's down. Well, actually, the oil trade's not so bad. It's only down. It's down 440 for the day, but it's down 120 since it's net okay since the open. What's the other one I have a bet on? Oh, the Russell. We have the Russell. And those are up $1,400 since the open because we shorted at 2,300. So we're good there too. And I'm actually being, you know, I'm just waiting for a nice drop. Although, frankly, I don't know why I didn't take the money and run on that one. That was a shameful thing. What was that this morning? I didn't even see that. Wow. Okay, I feel stupid. I just like that. That must have been up quite a lot at that point. I wasn't even paying attention. Anyway, so if oil comes back, or if we get back to a state of a normal activity, OIH is the oil service sector. These are the companies that make money servicing the wells and servicing the oil companies, you know, doing all the infrastructure work for oil. So as long as that sector comes back a bit, and obviously even if we just get back to $45 oil or $40 oil, it's going to be very helpful for the oil industry. This guy should do well. Valero is going to do well when people start driving again. More cars, more driving, more gas, more whatever. They're a refiner. And although, again, I don't like long-term demand for oil, even demand for gasoline, not great, but Valero makes money off the crack spread. In other words, so if the oil gets cheaper, but the gasoline is a little bit sticky, which it has been in the past, Valero does very well. So this is the price cheap enough where I feel comfortable getting in there. And if we do have inflation, if the price of oil does spike, you're really well protected. And we have the 60-80 spread here. And again, this one can make 500% upside. And I think 60 is a very, very good, very low price for Valero, even though it was below it twice in recent times. All right, so let's see. Oh, Powell, we forgot about Powell. Powell repeats, thank you, Mitchell, because Powell repeats appropriate to maintain the Fed's the rates at near zero until the economy reaches maximum employment. That's insane. We're so far from maximum employment. Inflation has risen 2% to 2%. Oh, we have to reach maximum employment. Inflation, which is currently being measured at 0, has to go to 2%, and on track to exceed it for some time. Not just 2%, but has to be over 2% to the point where they feel like it's heated up. And what is that doing to the actual market? Not much. Not getting a big reaction. I forgot Powell was speaking. Thank you, Mitchell. So more of the same from Powell, though. Rates are not going up. Nothing's happening. We're still going to push for this money printing thing. We talked about last week. We talked about that with the jobs and how we're 10 million jobs behind. 2 presidents, Obama and Clinton, and Reagan was close. Only those 3 have come close to 10 million jobs in one term. And Biden is not going to get to 10 million jobs in one term because this year is a bust. Obviously, he's coming in like Obama's first term, right? Obama didn't do it his first term because no matter what policy you have, you still have to change the policy that was already in place. So he's spending the first couple of months of his term just fixing all the crap that Trump did. Then he can start putting in his own policies and start improving things. 10 million jobs is a lot. And so what Powell is saying is we are good 1 year minimum, probably 2 years before he's going to raise rates. You can't be more dovish than this. You can't be more economically boosting than this. So, yes, we have plenty of hedges and we're starting to buy these long trades in our long-term portfolio. We're starting to buy more. And we need to start making money to cover it, and that's going to add to offset the losses we expect to have in the short-term portfolio if nothing falls. And nothing is going to fall if we just keep throwing money at the problem. You know, your house won't burn down if we keep drowning it in water, but at a certain point, the water does as much damage as the house, as the fire, as the house. The water does as much damage as the fire does. That's the problem with those kind of solutions, with firefighting and everything else. And the problem with money, it may seem great to just keep throwing money at the problem, but eventually you get into an inflationary spiral that is actually worse than if you had just let the freaking economy crash and adjust itself. Just as distorting, just as damaging. Our job as investors is to maintain inflation hedges, stay on top of our portfolios, and avoid these idiotic stocks where your money can disappear as fast, this fast. Well, not that fast. Where is this thing? Oh, that was a terrible example because it doesn't show a long enough period of time. You know what I mean. Okay, don't be in this kind of stock. Whoops, where is it? Here. Okay, and people were just asking me today about stocks that had doubled up already. I was like, oh, what do you think about this one? What do you think about that one? What do you think about this stock that doubled? I don't want to point fingers, so I'm not going to go back to it. But I think no. I think unless something fundamentally happened to the company, unless something changed about their business, that the chance of a company really being worth 100% more than it was less than a year ago is very, very slim. It's an incredibly rare and unlikely occurrence. And the real reason this is happening to these companies is because people are bored. You're all bored. You're looking for fun things to play. Okay, it's like if you sit in Las Vegas and you're standing next to a craps table or roulette table or something like that, and you're just watching and you're waiting for someone for like an hour, and they haven't shown up yet. They're supposed to be there, and you're bored. And what do? Yeah, you go, you start fishing in your pocket. What do I have? I got $10. I got $20. I got $100. You start going, yeah, I may as well play this game while I'm waiting, because you're bored. Not because it's a good idea, not because you're going to win, because you're bored. Not a good reason to play the market, especially with money that you're counting on. There are so many good, safe ways to make money. Don't gamble on bullshit. That is what I'm telling you guys, okay? And with that, we will end this webinar. Please consider what I have said, and we will do this all again next week. All right, thanks, guys.